The stock market split in two directions after fresh jobs data hit, and the gap tells you something important about where investor anxiety is right now. The Dow Jones Industrial Average climbed roughly 400 points. That is a solid gain for an index that tracks 30 large, established American companies. Your industrials, your financials, your consumer brands. Meanwhile, the Nasdaq composite, which is heavy with technology and growth stocks, struggled to keep pace. Same data, same day, very different reactions. So why the split? It comes down to how different types of companies respond to a strong labor market. When jobs data comes in solid, it signals that the economy is holding up. More people working means more people spending, and that tends to help the kinds of companies that make up the Dow, businesses with steady earnings tied closely to how the broader economy is doing. For them, a strong jobs report is broadly good news. For technology stocks, the math is more complicated. Growth companies are valued largely on what investors expect them to earn years down the road. Those future earnings get discounted against current interest rates, meaning when rates are high, those distant profits are worth less in today's dollars. That makes tech stocks especially sensitive to anything that might keep the Federal Reserve from cutting rates. And that is exactly the concern a strong jobs report raises. The Fed has been clear. It wants to see the economy, including the labor market, cool enough to bring inflation back down to its 2% target before it starts lowering rates. When hiring stays robust, it complicates that picture. Traders read a strong jobs number and repriced their expectations, less chance of a near-term cut, more pressure on growth stocks. That is the mechanism behind what you saw today. The Dow welcomed the economic strength. The Nasdaq absorbed the rate anxiety. It is worth stepping back for a moment. When people say the stock market went up or the market fell, that language flattens something that is actually quite varied. Different indexes track different companies. The same piece of news can be a tailwind for one sector and a headwind for another. Today was a clear example of that. What happens next depends on two things investors are watching closely: upcoming inflation readings and any fresh commentary from Federal Reserve officials. If inflation continues to ease, the Fed may still find room to cut rates, even with a strong labor market. If inflation stays sticky, that Nasdaq pressure could persist. The practical takeaway: when you see market headlines, look past the single number. Check which index moved and in which direction. The spread between them often tells you more than either figure alone. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.